This is Matthew Cratter from Bitcoin University, and today I wanted to talk about what it means to shut the exits and boil the frogs. This video is going to be context for a video I made a couple weeks ago, which was fairly controversial, in which I asserted that all of Coinbase's Bitcoin will be seized at some point, not next month, not next year, but probably in the next 5 to 15 years. And I think a lot of people thought this was really a prediction out of left field and wanted a little more background on why I was asserting something like this. So that's what I'm going to do in this video. The big problem that the U.S. has is the federal debt load, currently $34 trillion worth of government debt. And it's much worse than that when you take into account all the unfunded liabilities. It's more like $200 trillion worth of debt. This is not a problem that can be solved by tax hikes. You could confiscate 100% of the net worth of all U.S. billionaires, and it still wouldn't come close to fixing the problem. The real problem is that the debt load is so large relative to the size of the economy that is supposed to service that debt. So if we have $200 trillion worth of debt, when you add it all up, GDP, the size of the economy, is only about 28 trillion. So the total amount of debt, including unfunded liabilities, is almost 10x the size of the economy as measured by GDP. We're really at an extreme that a lot of people don't realize. The last time debt to GDP was at these levels was at the end, not at the beginning or middle, but at the end of World War II in 1946. And we're now basically at those same levels, having not even fought a world war. This is what's very disturbing. Someone needs to hold all of that U.S. government debt, and the real question is, who wants to hold a hot potato? Most foreign central banks and nation states are no longer that interested in holding this hot potato after seeing the U.S. freeze the assets of various countries, for example, what happened to Russia a couple years ago. So holding U.S. treasuries really presents huge counterparty risk to the holder if the U.S. decides that it doesn't like that particular country at that point in time. So if we take a look at how the federal debt has increased, the total debt on the books has increased over the past 5 years. It's gone from approximately 22 trillion to 34 trillion, so about 12 trillion. Of that, very little has been sopped up by foreign holders like central banks. They've only taken their holdings from about 6 trillion to about 8 trillion. So they've taken on less than 2 trillion of that 12 trillion worth of debt. A lot of that debt has instead gone into the U.S. banking system, being held by Federal Reserve banks. They've increased their holdings over the past 5 years from 2.5 trillion to 5.2 trillion. And then the rest of the holdings have really been taken on by the U.S. central bank, which is called the Federal Reserve. Back in the early 2000s, they had less than $1 trillion worth of treasuries on their balance sheet, and that really spiked after the pandemic. It peaked at approximately 5.7 trillion, and now they've been tapering that amount on their balance sheet. This is what the tapering is, also called quantitative tightening, but they're still holding a lot more than they were 5 years ago. And this is where a lot of the debt has gone. If you're enjoying this video so far, I just ask you to hit the subscribe button. That really helps this channel's engagement and reach. Hit the like button, leave a comment, question, suggestion for a future topic, as well as share this video with a friend or family member. So when debt to GDP is this high, Fed rate hikes, interest rate hikes don't work very well either. They end up blowing things up while not stopping inflation. And that's really been the story of the past couple of years. Inflation has stayed stubbornly high, while various things like the U.S. banking system have blown up. Small changes in interest rates can have an outsized effect on the economy because the amount of debt is so large relative to that economy size. And so when you change the interest rates, it changes the debt. And when you have a huge overhang of debt, that has an outsized effect on the economy as the value of that debt moves around due to interest rate changes, and you can end up blowing up, as we said, the whole banking system. Interest rate hikes by the Fed ended up blowing up the banks, which are still technically insolvent, but they blew up in March of 2023, as well as other levered parts of the economy like commercial real estate. We saw Silicon Valley Bank blow up as the value of their treasuries and mortgage-backed securities imploded in the wake of Fed rate hikes. So here's the real problem, which I've enumerated before on this channel. The U.S. government cannot stop spending because so much of it is essential spending, quote unquote essential spending, the entitlements, Social Security, Medicare, the defense budget, which we're not about to shrink with the current geopolitical situation with China and Russia, for example. And then we have interest on the debt, which we're unable to, or it'd be very unwise to default on that. So that's not going to be that's not going to be taken out of U.S. spending either. So this is the bulk of U.S. spending, including all the ridiculous things that are added to the budget in every administration. So the U.S. government cannot stop spending. Therefore, the U.S. government, federal government, cannot stop issuing new debt to fund that spending. Therefore, the U.S. government needs to find idiots to hold all of that debt. As we said, the foreign central banks have been saying no lately. So the plan, I believe, is to try to stuff a lot of that toxic debt, U.S. treasuries, U.S. government debt, into the domestic banks, into insurance companies and pensions. And this has already been done for many years using both carrots and sticks. We have this idea of statutory reserves when it comes to insurance companies. For example, you must hold X% of your balance sheet in U.S. treasuries. It's toxic waste, but we're going to change that and say it's okay because we're going to call it the world's only risk-free asset. And so a lot of regulation, a lot of financial regulation exists mainly to stuff the banks and insurance companies and pensions with this toxic waste called U.S. treasuries. And now, as Joseph Wong points out, there's a potential change in leverage calculations, which can make banks a limitless purchaser of treasuries just as future issuance is surging. So this is another place where the U.S. government can change the rules and force banks, or in this case it would be more of a carrot, encourage banks to hold more of this because it would not take up these additional treasuries, would not increase their leverage, and they would not have to hold capital against it. So this is incentivizing the banks to take down a lot of this U.S. Treasury debt, but the banks aren't big enough to take down all of it, as we're going to see. The next step would be propaganda, encouraging and even forcing individual Americans to buy and hold more treasuries, something along the lines of it's your patriotic duty, or you can do it to help save the environment, or you can do it to help fund the wars in various places. This is very similar to the propaganda that existed in World War I and World War II, in which people were encouraged to buy war bonds. What's the solution, the ultimate solution to the U.S. government debt problem? It's this. It's closing the exits and boiling the frogs. You get as many idiots as possible to hold the debt, and then the Fed prints a lot of money, buys up a lot of the debt itself, as it has been doing over the past 5 years, as we saw, creates lots of inflation. This increases nominal GDP, thus bringing debt to GDP ratios down to more normal levels, where traditional monetary policy can have more of an effect without, for example, blowing up the banks. So it's the idiots holding U.S. debt, holding U.S. treasuries. These are the frogs who get slowly boiled as they lose purchasing power, since the returns from holding that debt are much lower than the rate of inflation. So maybe you're making 4 or 5% on your treasuries, but the true rate of inflation is 6, 7, 8, 9, 10, 15% if you look at various indices. This is what's called financial repression, where the central bank colludes with the treasury to keep rates low, and thus to help the debt to disappear as people hold it and basically burn up their purchasing power holding treasuries that don't offer returns above the rate of inflation, thus bleeding purchasing power. For this to work, though, you have to close the exits. And the question is, can you think of an exit from the current financial mess that allows you to hold a bearer asset with a fixed maximum supply? This isn't gold, because gold supplies double every 30 or 40 years or whatever it is. But Bitcoin has a fixed maximum supply that protects you from fiat devaluation. And there's a way to hold this Bitcoin outside of all of the banking systems of the world. You can take it anywhere in the world with you by just memorizing 12 words. So this is an exit from this fiat financial mess. And this is an asset, Bitcoin, that could become the world's most valuable asset, since it offers everyone in the world, not just Americans, but everyone in the world, a way to escape from the global fiat mess. And this is a problem. These debt to GDP levels are a problem in most countries in the world, not just the US. But because we're still on a US dollar system, the US's problems end up bleeding out to the rest of the world. This may help to explain the establishment's irrational hatred of Bitcoin, which you think would otherwise be accepted as a cool new technology. And over the past decade, they tried to stop Bitcoin but failed. So I think they came up with a new plan. Let's herd everyone who wants to buy Bitcoin into Bitcoin ETFs. Let's create a giant honeypot of real BTC at Coinbase Custody and elsewhere that we, the government, can then tap if we ever need it, all the while discouraging sovereign usage of Bitcoin and people holding their own private keys and transacting without the government's permission. This is what a lot of the KYC rules involve, a lot of the travel rules in Europe and the UK, for example. And this is also why it's so important to hold your own Bitcoin private keys, Don't leave your Bitcoin on the exchange where it can be taken by anyone. Don't buy the Bitcoin ETF, which just ends up putting your Bitcoin on Coinbase. The Bitcoin at Coinbase Custody will eventually be seized to help to recapitalize the U.S. government, as I discussed in this video, which I'll link to in the description notes below. So that's the plan, basically. Close the exits, get as many people as possible to hold U.S. treasuries, let inflation rip, and boil the frogs holding treasuries. Meanwhile, distract the people with lots of bread and circuses, endless celebrity gossip, endless culture wars, red versus blue wars at home, forever wars abroad, also funded by Fed money printing, and then throw in some apocalyptic climate fantasies where Bitcoin miners are boiling the oceans, but the bread and circus providers like Netflix and other data centers are not boiling the oceans, even though they use the same electricity. All of which is to say that it becomes increasingly important for you to hold your own private keys, hold your own Bitcoin on your own hardware wallet in the years ahead if you want to be able to somewhat avoid this mess. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.